Assalamualaikum warahmatullahi wabarakatuh, and hi, my name is Siti Alia Masarah binti Sofyan. Our group will present about case study which are factors affecting exchange rate in Germany. Germany, as Europe's largest economy and key member of the Eurozone, has its exchange rate primarily influenced by the value of the euro against other global currencies. The exchange rate in Germany is affected by several economic, political, and market-driven factors. These include macroeconomic indicators such as inflation, interest rate, and GDP growth, as well as external factors like global trade dynamics, geopolitical events, and investors' sentiment. Additionally, the European Central Bank (ECB) plays a crucial role in determining monetary policy, which directly impacts the euro's value. Understanding this factor is essential for businesses, investors, and policymakers as they navigate the global financial landscape. There are several factors that affecting exchange rate in Germany, which are interest rate and monetary policy, inflation rate, economic growth and stability, political stability and global event, speculation and market sentiment, trade balance, and current account. For descriptive statistics, the minimum and maximum values show the range for each variable, with the year spanning from 2019 to 2024. The mean represents the average value, such as GDP averaging 0.0218, indicating slight economic growth. The standard deviation and variance measure variability, with the exchange rate having a standard deviation of 0.0578, suggesting fluctuation in currency values. Skewness indicates data distribution symmetry. A negative skew, 1.348 for the exchange rate, means lower values are more common, while a positive skew, 0.586 for GDP, suggests higher values occur more frequently. Curtises measure how big or flat the distribution is. Negative value, like GDP at negative 1.676, suggests a flatter spread data. This table provides a summary of a regression model where unemployment rate, inflation rate, GDP, and trade balance are used as predictors. The first column shows the correlation coefficient, indicating a strong positive relationship between predictors and the dependent variable. The second column, R-square, shows that 97.5% of the variance is explained by the model. Adjusted R-square, 875, account for the number of predictors, showing that 87.5% of the variation remains explained. The next column represents prediction error, where a lower value indicates better accuracy. R-square change 975 confirm that all predictors significantly contribute. F change 9.719 test model improvement, while SIG F change 236.
Assalamualaikum and hi, my name is Iman Hafifi binti Azman and my matric number is 20234376 and 76. In this presentation, I'm gonna explain about the ANOVA. The table summarizes the findings from ANOVA test, which is to look at how the factor like unemployment rate, inflation rate, GDP rate, and trade balance might influence the exchange rate. First of all, we can see that the sum of squares show us how much of the exchange rate variation can be influenced by this factor, which is 0.016, for the regression, which is unexplained variation 0.0100. Next, in terms of degree of freedom, we have 4 predictable and 1 residual, totaling 5 observations. We can see that the mean square calculation give us a sense of the average variation explained, with the regression mean at 0.004. The F statistic here is 9.719, which suggests the model explains more variance compared to the error. But the real kicker is the significant p-value equal to 0.236. This indicates that the model isn't statistically significant, as we typically look for a p-value below 0.05. In this page, I'm gonna talk about the coefficient from our analysis. So this table lays out some regression coefficients from a statistical analysis focused on understanding how various independent variables relate to the exchange rate. The understandized coefficients represented by B tell us how much the exchange rate is expected to change when each independent variable shifts by 1 unit. For example, a positive value for GDP, which is 0.546, indicates that as GDP increases, the exchange rate tends to rise as well. The standardized coefficient beta gives us a way to compare these variables more easily. Here, GDP has a relatively strong influence with a beta of 0.572, while trade balance shows a weak connection. Beta is 0.031. When we look at the t-values and significant levels, it appears that none of these factors are statistically significant because p-values over 0.05.
In this analysis, we explore how key economic indicators of Germany as GDP, trade balance, exchange rate, inflation rate, and unemployment rate are related to each other using Pearson correlation. As GDP increases, the exchange rate tends to rise, indicating a strengthening currency. However, the weak significance suggests that the other factors might be influencing this trend. Similarly, the relationship between trade balance and inflation rate shows a negative correlation of negative 0.422, but its lack of significance implies that while a worsening trade balance might contribute to higher inflation due to the increased cost of imported goods. Additionally, the exchange rate and unemployment rate exhibit a positive correlation of 0.751, suggesting that a stronger currency is associated with higher unemployment. This could be because a rising exchange rate makes export more expensive, potentially leading to job losses. Meanwhile, the inflation rate and unemployment rate have a slight negative correlation of negative 0.239, aligning with the Phillips curve theory, which suggests that higher inflation may reduce unemployment. However, the weak correlation indicates that this relationship is not particularly strong. Germany's exchange rate is shaped by various factors, but none have a strong effect. When GDP grows, the currency tends to strengthen, while higher inflation may weaken it. Unemployment and trade balance have some sort of influence, but their impact is limited. Overall, the global factors likely to play a bigger role in determining the exchange rate.